If you're just starting to invest, there's one huge mistake almost everyone makes, and it could be costing you big time. Whether it's chasing quick wins, ignoring fees, or getting swayed by hype, these common pitfalls can derail your financial future before you even get started. In the next 30 seconds, I'm going to break down what that mistake is and how you can avoid it, so your money can actually start working for you the right way. Today we will talk about every beginner does this wrong when investing. So before we start, make sure to hit the like button and subscribe to my channel. 1. Lack of clear goals. Many beginners dive into investing without defining clear financial goals. Without a roadmap, it's impossible to determine the right investment strategy or asset allocation. Are you investing for retirement, a home, or education? Each goal has a different time horizon and risk tolerance. Without clarity, you may end up taking unnecessary risks or settling for suboptimal returns. Setting SMART goals, specific, measurable, achievable, relevant, and time-bound, helps you tailor your investment choices effectively. Establishing goals gives purpose to your investments and a way to measure progress, which keeps you motivated and disciplined. 2. Ignoring risk tolerance. A huge mistake beginners make is not assessing their risk tolerance. Investing isn't one size fits all. Your comfort with risk should guide your portfolio choices. Taking on too much risk can cause panic during market downturns, leading to impulsive selling. Conversely, too little risk might mean missing out on growth opportunities. To gauge your risk tolerance, consider factors like your investment timeline, financial situation, and personality. Tools like questionnaires or working with a financial advisor can help. Matching investments to your risk profile leads to more sustainable and confident investing over time. 3. Trying to time the market. One of the most common beginner errors is attempting to time the market, buying low and selling high perfectly. Market timing requires predicting future price movements, which even professionals struggle to do consistently. Beginners who try often buy when prices are high and sell during crashes, locking in losses. Instead, a disciplined strategy like dollar-cost averaging, investing a fixed amount regularly, reduces the impact of volatility. Staying invested through market cycles historically yields better results than jumping in and out. Patience and consistency beat guessing games in investing. 4. Overlooking diversification. New investors frequently put too much money into a single stock or sector they are familiar with or excited about. This lack of diversification increases risk dramatically. If that stock or sector crashes, the whole portfolio suffers. Diversification means spreading investments across different asset classes, industries, and geographies to reduce risk. Mutual funds and ETFs make diversification easy, even with limited capital. A diversified portfolio smooths out returns and protects your investments from unforeseen shocks. Remember, diversification isn't about maximizing gains, but about managing risk smartly. 5. Falling for high fees. Fees and expenses can silently erode investment returns over time, yet beginners often ignore this crucial factor. Actively managed funds, frequent trading, and some financial advisors can incur high fees that eat into profits. Even small percentage fees matter because of compounding over years or decades. Always check the expense ratio of funds and be wary of high commissions or trading costs. Low-cost index funds or ETFs are excellent choices for beginners, offering broad market exposure with minimal fees. Keeping costs low is one of the simplest ways to improve net returns. 6. Not having an emergency fund. Investing without an emergency fund is a recipe for financial stress. Market volatility means you shouldn't count on investments for immediate cash needs. Beginners often put all their spare money into investments and neglect liquid savings. If an unexpected expense arises, you might be forced to sell investments at a bad time. Experts recommend having 3 to 6 months' worth of living expenses saved in a separate, easily accessible account before committing significant money to investing. This safety net allows you to stay invested for the long term without panic selling during downturns. 7. Reacting emotionally. Emotional investing is a major downfall for beginners. Fear and greed drive irrational decisions, panic selling during market dips, or chasing hype stocks. Emotional reactions cause you to deviate from your plan, often leading to losses. Developing discipline and detaching emotions from investing decisions is critical. Setting up automated contributions, creating a long-term plan, and periodically reviewing it without making knee-jerk changes helps. Remember, markets fluctuate naturally, and reacting emotionally often worsens outcomes. Emotional control is a skill that improves with experience. 8. Neglecting continuous learning. Investing isn't a set-it-and-forget-it activity. Beginners often neglect ongoing education, leading to outdated strategies or falling prey to misinformation. The financial world evolves constantly with new products, regulations, and market dynamics. Reading books, following reputable sources, and learning basic financial concepts empowers you to make better decisions. Understanding things like inflation, compound interest, tax implications, and portfolio rebalancing deepens your confidence. The best investors stay curious and adapt their strategies as needed, rather than relying on luck or hearsay. 9. Failing to review and adjust. Lastly, beginners often fail to review and adjust their portfolios regularly. Life changes, marriage, children, job changes impact your financial situation and goals. Market conditions also shift, requiring portfolio rebalancing to maintain your desired risk profile. Ignoring this can cause your investments to drift from your original plan, exposing you to unintended risks or missing opportunities. Scheduling periodic reviews, at least annually, helps you stay aligned with goals and risk tolerance. 10. Underestimating the power of compounding. Beginners often fail to appreciate the exponential growth potential of compounding returns over time. Compounding occurs when your investment earnings generate their own earnings, accelerating growth as years pass. Starting early, even with small amounts, can lead to significantly larger wealth compared to starting later with bigger sums. This is why delaying investing can be costly. Unfortunately, many novices underestimate how small, consistent contributions combined with time can multiply wealth. Understanding and harnessing the power of compounding encourages disciplined saving and long-term investing. 11. Overconfidence in stock picking. Many beginners believe they can outperform the market by picking individual stocks based on tips, news, or personal research. Overconfidence often leads to concentrated portfolios and risky bets. However, consistently beating the market is notoriously difficult, even for professionals. Individual stock prices are influenced by unpredictable factors, earnings reports, economic shifts, global events, that can cause sudden losses. Overconfidence also leads to frequent trading, increasing costs and taxes. 12. Ignoring tax implications. Tax considerations are frequently overlooked by beginners but can greatly impact investment returns. Different investments have varied tax treatments. Capital gains, dividends, and interest income are taxed differently depending on the account type and holding period. Not optimizing tax-advantaged accounts like IRAs, 400 and Onyx, or HSAs means missing out on growth opportunities and increased taxes. Additionally, frequent trading can trigger short-term capital gains taxed at higher rates. Tax loss harvesting and strategic asset location, placing tax-inefficient investments in sheltered accounts, are strategies that can improve after-tax returns. Being aware of tax consequences allows smarter planning and preserves more of your investment gains. If you like this video and would like to see more like it, please give it the thumbs up. Leave a comment and click the button to subscribe.